Today we're very pleased to have Stanley and Bruce here to give us their insights on the Chinese equity market. So first off, welcome to Bruce and Stanley. Thank you for joining us today.
Thank you.
Thank you.
So let's start off with a recap of the Chinese equities. So MSCI China fell by over 20% in 2022. So was this performance in line with what you expect at the start of 2022? Maybe you can start with Bruce.
Okay, that's a quite good question. I would say yes and no. No, because if you can travel back to at the beginning of the 2022, not many actually could imagine how aggressive the Fed would be and how strict the China's zero COVID policy could be. Yeah, and but yes, because as time go by, then the markets start to formulate this kind of expectation. And as compared to the Chinese regulatory crackdown starting in the second half 2021, which just hurt certain sectors, a aggressive Fed and also the strict zero COVID policy, their impacts are more broad-based in terms of the fundamentals and also the sentiments. But on the positive note, it's already there here. So after the Chinese Communist Party's 20th Congress in October, the Chinese regulatory crackdown and also the COVID policy both are relaxed. So these are combined with a less expectation for a less hawkish Fed did boost the MSCI rebound late last year. So if you look at the whole year performance, actually the MS China, the performance just slightly behind the S&P 500.
Thank you, Bruce. So similar question for Stanley. So what is your take on what happened for Chinese equities?
Well, I don't really have a huge expectation on the Chinese market, especially over the past few years. All I have, I don't have so much data as Bruce, but as an individual investor myself, and the observation that I have been seeing is rather disappointing, at least for my view, in the last few years for China market. And my observation is, although as much as China want to be self-reliant and detached from the US market and the US influence, I guess the financial market so far is still very dominated by the Western world and in particular the US, where most of the funds are coming from. And I feel that what is happening that we are seeing is because a lot of the US funds or Western-based funds are getting very hesitant because of the increased political tension and also the uncertainty with investing in China, and you're not sure what the government is going to do, what the policy is going to be like. And to them, regardless of how cheap that equity might fall and become, to them it might become just too big a risk. Right? It's not just on the Chinese side, but also in the US side, you wouldn't know what the US government is going to do, with the recent chip ban. This is something I guess not many people are, predicted. And now with Donald Trump coming strong again, then you wouldn't. It's becoming more and more unpredictable, I say, for the Chinese market.
Okay, thank you. So we'll stick with you, Stanley, with the elephant in the room actually, which is zero COVID in China. So markets are recently turning very optimistic that China is about to move away from zero COVID. But actually we saw in the past year that we saw hints of authorities pivoting, but it didn't come to fruition. So do you think China can successfully pivot from zero COVID this time?
I don't have a crystal ball on that. Of course, later on maybe I give Xi Jinping a call then. But what I also just as observe and from what I'm seeing is they are experimenting, right? They have tried very hard with a zero COVID measure. Clearly it's not working. And I guess now they're sort of moving to the next direction. But also that might, they're trying so hard to push for zero COVID at the beginning. It might be because also they realize that maybe their internal COVID vaccine wasn't as effective as what we have here. And just now when I was coming over on the news, they were just talking about Chinese government talking to Pfizer now, thinking of creating a derivative vaccine for them. So if that's possible, maybe they can reach a point where COVID isn't that scary for them anymore. And hopefully, everybody hopes that they can open up. It's not good, especially for the industry, that 1 week they're open, 1 week they're not open. It's not only affect them, it affects the rest of the world as well.
Yeah, certainly. I also hope that China will open up soon. So, Bruce, what are your thoughts on COVID reopening in China?
Yeah, I agree with Stanley on the vaccination progress. But if you look at the current reopening process, actually in November, China started with the reopening with at the very beginning it's a very gradual pace, but suddenly move into almost full relaxation. But I think it takes some time to achieve the genuine full reopening. This is because there will be always some back and forth. Particularly given that China has a large number of aged population with a relatively low vaccination rate. So we believe there'll still be a seesaw session because people in China, they may choose not to go out. So even now, there's no more lockdown available. So the potential turning point could be the second quarter. After the Chinese New Year and also the National People's Congress, because these two events will expect to bring a lot of mobility at the public level and also at the mobility level. So in addition to the vaccination, I think the weather may also be friendly to reopening in second quarter because it gets warmer.
Okay, that's good to hear on the potential reopening in China. So I guess one thing the COVID situation is really linked to is the economy in China. So China is expected to miss its 5.5% GDP target for 2022. So do you think China can see its growth rebound in 2023, especially as the world starts to see a growth slowdown? Perhaps you leave this question for Bruce.
Actually, I think this year, for 2022, their growth, definitely China will miss this growth target. But in order to achieve a so-called basic socialism modernization by 2035, China still needs to achieve a nearly 5% annual growth in the next 12 years. So from this perspective, the growth still remains the first priority. And we still believe for this year, the COVID-19 situation is still the largest fundamental. I think, just as you said, this is particularly true as the world growth is expected to be slower this year. The implication here is that China cannot rely on the exports, but has to rely on the domestic demand. And China does have some room for the active fiscal and active monetary policy measures. But all of this has to be accompanied by the reopening with the domestic-driven demand. And again, if China could finally use the vaccination with the mRNA technology, this will be also helpful.
That's good to hear. So I guess let's look on a more long-term basis now. So amidst these worries of trade war and more short-term things like COVID disruptions, companies appear to be talking more about, let's say, reshoring their operations away from China to, let's say, India, ASEAN, and so on. So Stanley, do you think this is a concern for the Chinese economy and markets?
Well, I guess it is a concern, but it's something, I guess, more inevitable. They have reached a point where they would need to do that to bring the economy to the next level, right? They cannot always rely on just cheap labor for the economy. And we see this transaction happening before, in Japan, in Taiwan, in Korea. And I guess what they're doing now in China is just at a much bigger scale, like something that we have never ever seen before in such a big scale. So the transition, they have to do it, but the transition might not, might take a very long time, and it might not be as smooth as what we have experienced before, just because of the massive scale that it involves. Right?
Okay, thank you. So let's move on from the economy to markets. So let's start off with big tech. So there have been multiple crackdowns on big tech in the past few years, and for example, we saw the ed tech industry in China become essentially irrelevant overnight in 2021. So right now, the government appears to be focusing on your more hard tech sectors rather than soft tech like e-commerce, gaming. So Stanley, do you think this is a risk for China big tech?
I think it's not so much of a risk, but maybe just as investor, we might need to realign our expectation on the soft tech companies, software companies. And a lot of them, especially when you talk about the biggest, say, your Alibaba and your Tencent, they are already so big until that they are integral to the society of China, right? Alibaba has about 1 billion active user, where the population is just 1.2, right? So either just all the babies are not having an Alibaba account, or people are having multiple accounts. But that say that it means that almost everyone that has a phone would have Alibaba account, has a WeChat account, and that's so integral part of their business. But I guess over the past few years also, with the more and more regulation, the government is hinting everyone, including investors, that no matter how big your company becomes, the government is still the top, right? And over the past decade, when we are investing in tech company, especially in the US, our assumption as investors is tech company can grow as far as the sky is the limit. And US tech company has shown us, they are so big until sometimes the government cannot control them. And because their lobbying is so strong as well, sometimes the government itself is under the hands of all these big tech. But that's not going to be the case for Chinese tech company at least. So they will continue to still be able to grow, I think. But we have to be wary that if we assume that they will become as big as the US tech company, that's highly unlikely, right? Highly unlikely, and most likely there will be a ceiling for them, or they will need to be break out to many multiple smaller companies over time. Right?
Okay, thank you. So I guess the important thing is to realign your expectations when it comes to the soft tech and big tech. So let's move on to hard tech. So we've seen recently that the US has imposed sanctions on high-end chips on China, and Netherlands and Japan look to be joining as well. So do you think Chinese firms can achieve self-sufficiency in chip production?
Okay. I would say it is not a total surprise for such sanction because the high-end let's say the cheap manufacturing actually are related to the core competitiveness between China and US or even the whole Western world in the next 20 to 30 years. But on the other hand, I think for those producers, I think I just echo your points that they at least have a strong policy support in two dimensions. First, the government has a direct subsidy and also has the capital market support, such as the Shanghai Technology Innovation, the STAR Board, and also the Shenzhen Chinex Board to provide some direct or indirect funding for them to conduct the R&D, the research and development. And second, as the world's second largest economy, China's governments at different levels and also the China consumers can act as big buyers. So these can help those chip producers to cultivate their own markets and spend more efforts on the R&D. So from this perspective, I think we're still constructive on those names in the long term. And more importantly, when we talk about hard tech, it not only includes those chip producers, but also consists of the healthcare names, such as the medical equipment, vaccine producers, and also the new energy names, such as the solar energy, and also the EV batteries producers. So those names are subject to relatively less sanction risk, and some of the leaders there already have a large market share in the world. And in terms of the valuation, those kind of names, their valuation obviously is higher than the value stocks, but as compared to their previous peak names, their valuation now are more attractive, and their potential net profit growth can be huge, but not everyone. But some of them, their leading names, their potential growth rate sometimes can be like high end of the double digit or even the triple digit growth.
Okay, thank you for your insights, especially on the strong earnings performance we can see over there. So, as a whole, perhaps we'll start with Stanley. Do you have any sectors, themes, company names maybe that you prefer within the Chinese equity space?
Well, as an individual investor myself, so I like to stay within just my circle of competence. And I'm both invested both in the Chinese companies and also in the US companies. But I tend to focus more on consumer companies, tech companies, and also the financials. And in particular, I think Chinese financial firms are at a very, very attractive valuation now, right? Some of the banks, even big names, they give around 8-9% dividend. And so far, at least for the past decade, they have shown that their dividend will be consistent. Sometimes they will drop a little bit, but at least still consistent over time. And it's a critical industry for China, and I think the government would not regulate it too much to cripple the industry as a whole. So that's one sector I'm quite optimistic about.
Okay, thank you. What about Bruce? Anything?
Sure. I would say if the China managed to overcome the current difficulties, finger crossed, I believe we will first see a beta rally, which could benefit both the value stock and growth stocks. And in particular, just agree with you. I also constructive on the consumption stocks. For example, the consumer discretionary and also those soft tech names, and even developers could benefit from this rebound. And in the middle to longer term, the growth names aforementioned, such as the healthcare, the new energy, and electronics, will continue to benefit from the China's national strategy, particularly for those leaders which are gaining market shares in and outside China.
Okay, so as we end off today's panel, I guess same question for each of you. If you had one single reason why you should invest in China, what is that one reason? Maybe I'll start with Bruce.
Okay, maybe I just share one sentence. I think if you look at the valuation chart, obviously now is the time to capture the China's future growth, aimed at attractive valuation and the ongoing reopening.
Okay, how about Stanley? What's your one reason?
Right. For me, I guess it's a market that, regardless of is a market that we cannot really ignore, just because of the sheer scale of the market, and it's going to be the biggest growth story the world have ever seen, and it's definitely one that either we can manage our expectation, but it is the one where we cannot totally ignore. Right?
So attractive valuations, a market you cannot ignore. Thank you very much to Bruce and Stanley for joining us today.
Thank you.